Welcome to Turbo Impact, where we navigate sustainability in private capital. I am your host, Kenny Chen. Each episode, we sit down with investors, allocators, and corporate leaders shaping the next era of sustainability. We explore how capital is driving the global transition and how today's decisions are shaping the future of impact. Thank you for joining us. This podcast is brought to you by Turbo Net Zero, a pure-play sustainability advisory firm driving impact across the private markets. In this episode, I am joined by Paul Hailey, Head of Impact and ESG at responsAbility Investments, one of the world's leading impact investment firms, managing around $5.5 billion across emerging markets through three core themes: financial inclusion, climate finance, and sustainable food. Paul oversees how responsAbility integrates impact into every stage of the investment process, ensuring that capital not only does no harm, but actively contributes to positive change. We discussed responsAbility's approach to building meaningful impact, why meeting essential needs also represents a strong financial opportunity, and Paul's reflections on how the industry can stay true to its purpose as impact investing continues to grow. Here's my conversation with Paul Hailey. Hi, Paul. Welcome to Turbo Impact Podcast.
Hi, Kenny. It's a pleasure to be here.
Can you start by telling us about your role at responsAbility and what first drew you into impact investing?
Sure. Well, I am the head of Impact and ESG at responsAbility, which is a specialist impact investor asset manager. We have around $5.5 billion in assets under management, and the vast majority of our activities are focused on emerging economies. And my role within responsAbility is to run the Impact and ESG team. So we are here to do the analysis of our investments to make sure that they are sustainable, basically. They do no harm and they actually make a positive contribution. And in addition to that, of course, we are there to not only look at the investments, but also to also communicate to investors, to deal with some of the regulatory elements around that, and to effectively also act as an in-house knowledge center around the topic. In terms of my journey towards this, I had previously worked in finance for a few years. I took a bit of time out to do an MBA, and during the course of my MBA, there was a social business certificate at the place where I was doing that, and that pushed me towards taking an interest in impact investing. So now I have been working in impact investing as a space for around 16, 17 years, and within responsAbility for 15 years.
I guess this question is in everyone's mind. What's the difference between ESG and impact investing?
That's a very good question. So I think if there's one thing I've noticed, and I don't think this is the only corner of finance where you tend to have this kind of situation, is that if you walk into five different ESG impact investing houses and say to them, how do you define ESG? You'll probably get 7 different answers. So the way that we define it, and I think that most people in the market would define it, would be that, look, ESG investing can be a broader umbrella, but it can predominantly be the idea of, look, try and just eliminate the worst activities and then invest in the rest, right? And, or at least invest in a best-in-class type of approach. Impact investing is more the idea of trying to find investments that not only do no harm, but also genuinely actively make a sustainable contribution and have a positive effect on the big crises that we're facing today from an environmental or social perspective. So to find business models that are really geared towards creating a positive impact in the world.
Speaking of positive impacts, so what is responsAbility's overall impact thesis and how does it come to life across your different investment strategies?
Sure. Well, look, responsAbility was originally created back in 2003 following a cycling trip, which was taken by one of our founders. So he was going on a cycling trip through Sub-Saharan Africa with his wife. And one of the things that occurred to them from all the people they met and the conversations they had and everything else was, look, there really is a need here. There's so many people here, so much brilliant entrepreneurial spirits, so many possibilities here. What's needed here is the kind of support that will allow people to start their own businesses, to start their own ventures, to flourish in the same way that we have in Europe, but where is not necessarily so available. So this obviously was in part sparked by the fact that he also had an interest in microfinance as an idea. And so when he came back, he created responsAbility, where the idea was really to allow investors in Europe to invest in microfinance as a theme, and then and then ultimately for that to support local financial institutions in developing markets to reach low-income households and small businesses and allow them to grow, basically, and to provide them with loans and other financial services, which is even today a problem. You still have 1.4 billion adults in the world who don't have access, who don't have a bank account, for example. So that was the start of responsAbility. That was the genesis. And since then, the thesis has been that responsAbility is looking to address the twin crises of our moment, which is the environmental crisis, so climate change, and also collapse in biodiversity, and also the fact that at the same time, the social crisis that we face in terms of inequality, in terms of lack of access to essential services. And we do this by, as I said, predominantly tackling, looking at emerging markets, emerging economies, because for us, that's where you can achieve an awful lot of the biggest impact, where you can have the greatest contribution, because there are relatively few other investors that are going into the space, and where you really need to have a deep and profound knowledge of the topic in order to go in there. And where also it should be said, as I mentioned before, I picked the 1.4 billion there. That is 99% of that is in emerging economies. So there are certain topics where you have to go into emerging economies to make a difference, and where you have to have a certain know-how and expertise to go in there. So that's really the thesis behind responsAbility. The genesis was on providing access to an essential service, which is access to finance. And that thesis has grown to include, looking at many different areas. We are still involved in the financial inclusion space, but we also work within sustainable agriculture, where again, you have a lot of smallholder farmers and other agricultural organizations that has lack of access to investments, that have lack of access to critical inputs, that have lack of access to a lot of other elements, and where there's a need also to improve them in terms of their sustainable activities. And climate finance, where really, again, there's a lot of really exciting and new and interesting business models that are out there in emerging economies, and where an investor can walk in, can provide capital, and at the same time can also help those organizations to improve and to grow. So that's the thesis of responsAbility, effectively, is to primarily target emerging markets, but also more broadly speaking, to try and help organizations to grow and to become the solution to those twin crises that I mentioned.
Obviously, you are addressing and meeting critical needs in emerging economies. It's a very impactful focus, but why it's also considered a financial opportunity for you?
Look, these needs that I mentioned before, these essential services, if you have a set of economies that are growing very rapidly, these are economies that are growing far more quickly than the developed world. If you have the economies where they're also growing from a demographic perspective much more rapidly than the rest of the world, and if you have essential needs that are not being met, then that obviously shows an awful lot of potential, an awful lot of opportunities. So fundamentally, if you can find business models that are geared towards meeting these needs, that have at their core the idea of trying to create a positive impact, then those are clearly also going to be business models that could experience very significant growth. Whether that be a microfinance institution that sets up in a market and caters to a clientele that that up until that point are having to rely on informal money launderers with money lenders with unscrupulous practices. And they are bringing, look, decent, transparent lending processes. Or whether you have an organization that is providing off-grid solar home solutions to communities that until that point just didn't have access to electricity. The point is, these are fundamental human needs that are being met. So if you're providing all of those things, clearly you're going to experience very significant growth. What investors need to see, though, is that we are doing this in a way that ensures that, yes, these are business models that are, meeting essential needs in a fair and transparent manner, and that they are not, and that ultimately their practices towards the customers and the staff and the communities of those organizations are completely correct and above board. So that's what we do as a lender, as an investor. We are there to look at organizations, check that they're acting correctly, but also identify organizations that are meeting these essential needs. And then once you're able to do all of those things, clearly the scope for growth from both a financial and an impact perspective is very significant. I mean, I can give you, there's so many numbers out there, but I could give you a couple. One would be, if you look at the next, between 2025 and 2027, according to the IEA, 85% of the increase in electricity demand will come from emerging economies globally. I mentioned before the number of the world's unbanked that are in emerging markets. You also have enabling factors, things like, again, if you just take India alone as a country. Now, rural India a few years ago had virtually no internet connectivity. By 2030, you're going to have 650 million people in rural India who will have access to the internet and who will have smartphones or access to smartphones. Now, to put that in context, you have 450 million people living in the European Union, right? So there are all these enabling factors. There are all these opportunities out there that are really very significant. And if you're an impact investor in emerging economies, and those economies, you have a good, strong local presence, then that's clearly a huge opportunity.
Very vivid example and statistics. So in terms of your investment process, how do you integrate intentionality and contribution in your investments?
Well, see, now those are good questions, and we get those a lot from investors. The intentionality is something where I mentioned before the idea of making sure that you have business models that have impact at their core that you're investing in, right? So every one of our products is going to have an impact thesis. It's going to, that sounds a little grand, but it's basically, intentionality is ultimately the idea, and it's not so revolutionary, of saying that, look, when you start doing impact investing, have a clear idea of what you want to do and make sure that you do it, which doesn't sound too hard, but is, I think, quite a critical component here. So you have an impact thesis, which says, this is what we want to do. These are the impact strategies that the fund has. Be it, creating financial inclusion, be it helping smallholder farmers, be it promoting, being reduced, carbon emissions, etc. And then have a mechanism to transform that thesis, to make sure that that thesis is reflected in your portfolio strategy. So, for example, have an impact scoring that looks at the underlying companies that you're investing in, and which says, look, are these genuinely in line with what we're trying to do? Or have a set of KPIs, or have some other means of analysis that allows you to make sure that this is the case. And then make sure that this is lived throughout your investment process. Make sure that you're then collecting metrics afterwards that allows you to check that this is still ongoing. Make sure that this is also reflected also in in your investment committees as well, and in your decision-making process, and in everything around your investment process, basically. Now, one element of that intentionality has to be contribution. You have to be able to say, well, look, we're coming in, we're looking at a company, they're a great business model, but what are we bringing to the table, right? So again, from our perspective, I gave you the example of an impact scoring. Several of our products have impact scorings in place that we've developed ourselves. And the question of contribution is integrated within those. So we will have an impact scoring that will look at the context in which we're investing. What is the need? It will look at who is meant to be the ultimate end beneficiary of these activities. It will look at, how big is the company's impact? And it will also look at look, what are we bringing with an investment? Ultimately, if it's a great company, but our investment is, really achieving, and making zero difference to them as a company, it begs the question, well, is there really much point in us investing? Are we going to get much from this from an impact perspective? Arguably, is this even necessarily a great financial opportunity? So we will incorporate that within our impact scoring, and we will look at questions like, what are we bringing from a financial perspective? Are we bringing anything beyond a financial perspective as well? In terms of, are we bringing, do we have plans to engage with this organization to help them get better? So that's really how we try and integrate it throughout our, within our process.
Diving deeper into your holding period on the contribution side, how do you engage with your portfolio companies and add value from an impact perspective?
Well, there's a few different routes that you can take. I mean, the first thing is that we're only doing private investments. So that already allows us to, means that there is a direct flow of money from our investors to us, to these companies. We sometimes, it sounds a little bit perhaps pretentious or poetic, take your pick, in terms of what we sometimes call a golden thread, in terms of the money comes from our investors. In the case of microfinance, for example, from our investors into the fund, to the microfinance institution, and then gets lent out to someone who is, let's say running a stall somewhere in Mumbai, or who is running a small company somewhere in Nairobi, right? So there is that already direct contribution, direct flow of money from one to the other, which I always think is quite a nice idea. But beyond that, beyond the financial contribution, there is our ability during the due diligence process to engage with the companies and say, to talk to management to say, look, these are ways that you could improve your impact. These are ways that you can improve around certain elements of your ESG standards. If we do an investment and we say, look, broadly speaking, this company is good, but they really should put this in place. They should improve that. They should, they haven't, for example, got a formal anti-harassment policy on an HR level, or there are certain elements around their workplace health and safety we don't like. We have the capacity to introduce what's called an ESAP, or an environmental and social action plan. And this is something, and again, this is a benefit of doing private investments. This is something that we can include within the loan agreement, where we can say, okay, within 6 months or 12 months of our disbursements, you must put in place this, this, and this. And this is something that is legally binding for the organization. And this is something that my team will directly take care of. So they will directly engage with the investee. They will try and identify the needs, and they will help them to put that in place. So this is something where beyond the finances, this is value that we can bring to these organizations, some of which have never had foreign investors before. So for them, this may be the first time that someone has said to them, you should really put this in place, for example. We also have a climate advisory team that's able to engage with some of our climate finance investments to help specifically on the topic of emission reductions and helping to introduce green products. And then we have certain of our funds that will have a small pool of donor money next to it called technical assistance, which will allow for them to pay for consultants who can come in and specifically put things in place. And then you also have, again, for some of our other products, we will have a specific focus on gender as a topic. So there we will ask organizations to put in place a gender action plan, which really targets the question of equality within among employees, and also helping organizations to produce products that specifically target women in emerging economies. So that's the different channels that we have, basically.
And responsAbility also uses blended finance model to mobilize private capital. So can you explain how blended finance works and why it is powerful?
Yes. So blended finance is it's something that's very interesting and very exciting for our industry, in the sense that at its most basic level, it is talking about a mixture, a blend of money from public sources, i.e. government sources. So development finance institutions, be it multilateral ones like IFC, the investment arm of the World Bank, or be it country-specific ones, bilateral ones, like, for example, Proparco, which is the French Development Agency, or KfW, the German one, or FMO, which is the Dutch one. So what it would be is a mixture of fund, investment from that side, plus private investors, be it institutional or be it pension funds, be it high net worth individuals, be it whatever else, family offices, whatever else. So it would be products that have investors from both of those sides, right? Now, this might seem like, okay, well, it's just investors like any other, but some of the structures you can build around this are quite interesting. One of the more classic examples is the idea that you have some of these development agencies or DFIs coming in and providing funding on a slightly concessional basis, so accepting a slightly lower return relative to the risk in order to try and attract and catalyze private investors, which from the perspective of a DFI is quite interesting, right? They're providing funding, and in the process, they're catalyzing sometimes as much as 5 times the amount in private investment. So then that allows us as an investor to go out to start targeting business models where previously might have been difficult to create a risk return profile using purely private investment that would have worked. So speaking from a responsibility, but it also at the same time means that some of those DFIs will come in also with some technical assistance funding alongside of it as well, which is very interesting for us. So it allows us to heighten and improve the engagement that we do with some of those companies. In the last few years, this has really enabled responsibility to move into some very new and interesting areas and to really achieve a great deal of impact. So we've been able, with the help of our friends and our investors at some of these DFIs, we've been able to move into products that provide, for example, lending towards local financial institutions so that they can provide green loans within their markets. Often they're the first financial institutions to do that within an emerging market, within those specific markets. It's allowed us to target off-grid solar energy providers. It's allowed us to provide investments in climate-smart agricultural practices. So it's really opened the field for us quite a lot in a lot of respects, this particular structure.
Impressive. What developments are you seeing among LPs in impact investing, especially when it comes to the preferences of retail versus institutional investors?
It's a very good question. I think thematically, there are some topics that are evergreen. Regrettably, the climate crisis has not yet gone away, and it is not going to go away for a few more years yet. So it is still an ongoing challenge to try and address that. And there are other topics as well. Access to finance remains a topic. You also see things like biodiversity that has become increasingly top of mind for a lot of investors. So biodiversity and nature-based solutions, I think up until a few years ago, weren't quite as prominent. Now it is a topic that comes up very frequently. Gender equality is still a topic, albeit one that maybe isn't talked about quite as much as it was a couple of years ago, but still it's very much top of mind still for a lot of our investors. So these are all major topics from a thematic perspective. What I think is interesting is that if you look at the activity of different investors, among retail investors, I think we have found that they do tend to focus on specific topics sometimes. However, some of the bigger institutional investors, I think the DFIs as well, that's the same case, but among some of the other institutional investors, for them, they sometimes view impact as just a theme by itself, right? So they're not necessarily focusing on specific sectors. What they're saying is, no, we want products that will allow us to address impact from a variety of different angles, to look at a variety of different topics. And I think up until this point, responsibility, we've been much more single sector kind of focused, but we are increasingly seeing that there are a lot of institutional investors that are really taking more of that approach. And perhaps it's interesting to try and think about how we might address that demand, basically.
You've written about the risk of impact washing. In your view, what separates truly impact-driven managers from those using impact as a marketing label?
I think look, if I was going to look at a because we do look at funds as well ourselves. We have a fund of funds offering. So sometimes I'm on one side of the table, sometimes I'm on the other side of the table, which is always quite interesting. And of course, when I am looking at funds and we're interviewing them, what I try to think is, look, what are the questions that stretch me and that, that I think are the good questions and where I think are really genuinely meaningful. I think the first thing is to say, look, you can really tell when you've got an impact product that is where they sort of started off with, we want to invest in this, and then afterwards they've retrofitted an impact rationale onto it. It becomes very obvious. You start to see a kind of a creaking at the seams, if you will. So first of all, what I think is important is to try and understand, look, what is your impact rationale and how is that present throughout your process? Okay, great. This is what you say. This is what you claim you're doing. How do you make sure that that is reflected in your portfolio strategy? How do you make sure that this is reflected in the reporting that you do as well? So I would say that's the first question that really should be asked. Is there a clear, coherent line throughout their impact process? And the question you can do afterwards to check out that is to ask the question, okay, what would you not do? Give me an example of when you have rejected a company and on what grounds, because it didn't match your impact rationale. I think if those are two relatively simple questions, but if you're talking to a fund manager and they're struggling to answer that, then I think for me, that's possibly a sign that that's the case, that's something that needs to be addressed.
There has been a lot of work around aligning and converging on impact measurement standards. Do you think we're getting closer to a common language for measuring impact?
Yes. Look, I think there is a certain degree of convergence. Now, some of this has been forced by regulation in Europe, notably with the rise of SFDR. We also see that there are certain standards that are very that are being adopted by a lot of people within the space of impact investing. So that would be things like the 5 dimensions of the impact management project, which is now Impact Frontiers. That would be the operating principles for impact management, which were originally created by IFC, but are now run by the GIN. IRIS Plus, which is a set of commonly agreed metrics. And you have other things in the climate space as well, of course, PCAF and GHG protocol and things like that. And then, of course, on a more general macro level, you have things like the Sustainable Development Goals. So I think there's a greater degree of harmonization than there was, say, 5 years ago, for example. Nonetheless, because there's a lot of different ways to achieve impact, I think we're still quite some way from the thing that we often hear from a lot of investors, which is like, can you just give me one number or one rating, across the whole industry? I think we're still quite a long way from that point. And of course, as long as we are a bit of distance from that point, then you always run the risk of impact washing or greenwashing as a result. So investors still, I think, have to be willing ultimately to look at impact investors and say, no, hold on, really explain to me how you're applying these standards and what you're doing with them. So there still is a need for due diligence until we get to that point, I think.
Europe has been leading the way in sustainability and impact regulation. How has responsAbility responded, and what takeaways could you share?
Well, it's been an interesting experience. I think if, like me, you work within the impact and ESG management function of an organization, you've seen your function turn into a regulatory function, which is already quite an interesting experience. I think from a regulatory perspective, the introduction of SFDR has catalyzed a lot of thinking and a lot of focus on an even greater focus on sustainability. There are some European markets that are particularly sensitive to impact investing that are very interested in it. Switzerland, Netherlands, UK, Germany. Those are all markets where that's really picked up. And obviously the fact that there is a regulatory framework behind it has helped. Nonetheless, there are limits to the regulation. If you take SFDR and the EU taxonomy as an example, they are not really geared towards the realities of emerging economies. It's not something that's really set up for that. it's a regulation that has tended to go where the bulk of assets currently is, which is to say most ESG assets are in listed assets that are in the developed world. But then, of course, it begs the question, well, should that be the case? Should we, when you bear in mind all the numbers that I quoted before about lack of access and growth and everything else in emerging markets, should we be looking to push more assets into emerging economies, into sustainable investment within those spaces? And I think that's something that probably we all need to think about a little bit more. There is a revision of SFDR that's due pretty soon. We'll wait and see whether the emerging economy angle is more incorporated. But there is an element sometimes for the likes of responsAbility and others that when we're trying to really apply and incorporate the requirements of SFDR, it's not something that's fully adapted to the realities of our markets. So hopefully this is something that will change over time, though. In the interim, though, I think I still remain relatively optimistic of the power of regulation around this space and the fact that it can hopefully provide greater transparency to our investors. Because I think anyone who is truly doing impact investing and who is really committed to it and really focusing on it like we are, it can only be a good thing if ultimately we are all pushed towards greater transparency. I'm a great believer in the power of daylight, basically.
I ask every guest this question. What do you think is the most effective way to turbo impact in your field?
I think there's a lot of the things that I've mentioned before about transparency is one thing that I think is very important. I think that there is an awful lot of potential from technology as well. I know everyone in every podcast right now is talking about AI, but genuinely within our field as well, AI has an awful lot of potential in terms of improving transparency around impact achieved, in the sense of providing, and when you combine that with the fact, as I mentioned before, in a lot of the economies where we're operating, there are huge swathes of the population that are coming online for the first time. Now, they're coming online in their own languages, but that's not a barrier for AI, as we know. So if you combine those two things, the power of technology from our side, with the fact that there is for the first time this connectivity, I think it's really exciting in terms of the potential for us to really understand that when we make these investments, when we support these business models, are they genuinely having an impact? So if we're able to combine that with the fact that then all that's left is the need to mobilize investment in that space. Right now, there is, right now, if you look at the need for investment and the need for what's out there at the moment, the estimate is that somewhere in the region of $4 trillion per year is required in order to meet the SDGs. So in emerging markets, that is, right? So if you factor in the fact that $1.4 trillion of that is currently being provided, that leaves you with quite a big shortfall. That leaves you with around $2.6 trillion per year in investment. Now, that seems like a huge amount of money, but you put it in the context of all of the money that is being currently managed and invested in the world on a day-to-day basis, you're literally talking about moving the needle by a couple of % in terms of global assets. So if we can even get towards halfway towards that number, then we could do a huge amount to address the big development topics of our day. We can do a huge amount towards addressing climate change. We can do a huge amount to addressing poverty, towards addressing inequality. And we all know what the economic benefits of that will be. The economic impact of climate change is going to amount to, tens, hundreds of trillions of dollars over the next, 30, 40 years. The missed economic potential from having still billions of people who don't have access to finance, who don't have access to education or health or electricity is huge. But the potential from bringing all of that in line, from investing in that space, from doing more in the space is colossal. So it's in our hands, basically, is the point I'm trying to say. The possibilities here are within our hands. if we can just move towards, move in that direction and harness the benefits that, that are possible with technology, are really colossal, in my opinion.
Thanks,
Do the
Paul.
rest of your guests
Yeah.
sound that optimistic? That's the
Yes.
question.
Yeah, that's very good. I want to thank you for being the believer in daylight and a impact leader in the field. And I want to thank you for your time for joining Turbo Impact Podcast.
And thank you very much for having me on. And thank you so much to all of your listeners if they've made it this far. I hope this was interesting.